Hello, in this video we'll consider bad debt deduction. Now it's important to understand that bad debt deduction can be both business and non-business. So there's really three criteria in this checklist that must be considered for whether a bad debt deduction is allowed. So the first is that there must be a bona fide debt. Was the taxpayer owed a bona fide debt? So the regulations specify that a bona fide debt is a debt which arises from a debtor-creditor relationship based upon valid and enforceable obligation to pay a fixed or a terminable sum of money. So the key is that there's a debtor-creditor relationship. There is a valid and enforceable obligation, and it's to pay a fixed or determinable amount. Fixed or determinable amount of money. So you really need those three things to prove that there is a bona fide debt. The issue here is that lots of times friends or family members will sometimes, maybe possibly transfer money to another party, and there wasn't strong enough, or there wasn't concrete details about, okay, will the person definitely repay me? There wasn't any documents prepared. So the issue becomes, under the tax law, can every single little, possibility of transfer where there might be been even a little intention to repay, well, is that going to be a bad debt deduction allowed on a tax return? Again, there has to be a debtor-creditor relationship under law. It has to be valid and enforceable obligation. So there must be, under the law, some valid enforceable obligation. And a fixed or determinable amount of money is specified. It can't just be, okay, well, they were supposed to repay me. No, that just seems too, it's not concrete enough. So it's really a facts and circumstances consideration. By the way, this comes from the regulations. This is from regulation reg. So section 166 deals with bad debt deduction. This comes from reg 1.166-1C. And this is probably one of the most important parts of determining the bad debt deduction. So it's a facts and circumstances analysis. Now, there's been case law. There was a tax court case called Delta Plastics Corporation versus Commissioner, where there must have been a contemporaneous intent by both the taxpayer and the borrower at the time of the loan to create an enforceable obligation. So additionally, beyond the regulations, there must have been an intention by the parties that this be a bona fide debt, and it must have been the time the loan was created. So it can't be after, at the time the loan created. That's really key to determining if there's a bona fide debt. Now, if there's not a bona fide debt, then whether it's business or non-business bad debt, it can't be deducted. It's just not allowed. So the next consideration is whether the debt has gone bad. Has the debt become worthless in whole or in part? So we'll talk more about the whole or part issue, but that is important later on. Whether it's the full amount of the debt or a partial amount of the debt is considered gone bad. So to determine whether the debt has gone bad, again, it's facts and circumstances. So again, we look at the facts and circumstances. And through the case law and the regulations, there's been some guidance about what exactly debt gone bad has meant. So there's numerous factors. So it's a factors test, and we consider things such as the debtor's insolvency or bankruptcy, right? That's important because if they're insolvent or bankrupt, then if they're bankrupt, they're not going to be able to pay. But if they're insolvent, maybe they can't pay up to a certain amount, and that's why it makes it a partial bad debt. Lack of assets, what assets actually the debtor has. Persistent refusals to repay. So the creditor contacted the debtor many times to repay, but there's been refusals to repay. Ill health. ill health on the part of the creditor. So maybe there's ill health, so they're just not going to repay because they know that they can't make money. They're not in a state where they can. Death, if death occurs, and there's other factors as well. Now, there's one thing I want to mention, and that is that under the regulations, the taxpayer is not required to take legal action against the debtor. So the creditor is not required to take legal action to show, look, I've been trying to get this debt, but there's been persistent refusal. You're not required. The debtor is not required. Creditor is not required to take legal action. Put that in there. Take legal action with respect to determining whether this has gone bad. And that's under the regulation. That's under Reg 1.166-2B. Now, the facts have been through case law, through regulations, whatnot. The bankruptcy issue actually came through Reg 1.66-2C with respect to that item. Now, the last topic I want to consider, so if there's a bona fide bad debt, then it can be deducted. If there's not a bona fide bad debt, it can never be deducted, whether it's worthless or not. If it's gone bad, then it can be deducted when it's gone bad. So it's when. When has it gone bad? Whether it's full or partial is going to make a difference. When it has gone bad. That's the year. So this is more of a timing. So the first requirement is more of if you don't have it, you can't deduct. But the second requirement is more of a timing issue. This is more timing. It's when it's gone bad. And finally, we have to determine whether it's business or non-business, because there's going to be various issues we have to worry about. So business versus non-business. Non-business is investment or personal in nature. Investment or personal in nature. And business is trade or business. Now, to determine whether it's considered a business bad debt or non-business bad debt, we have to consider the same requirements of trade or business under Section 162, which is the general business deduction. So to determine what business is, see Section 162, the trade or business definition, right? The Higgins case. Higgins. Same consideration. We talked about trade or business versus investment. So some examples of non-business bad debt you might be wondering that are personal. Again, if like a family member loaned money or a friend loaned money, but if it's business, it's actually being loaned in the actual process. It's actually like accounts receivable, or if you're actually in the business of loaning money. So if it's a business bad debt, it can be deducted whether it's fully worthless or partially worthless. So if it's fully worthless or partially worthless, you can deduct. Again, if you meet the first two criteria. If it's fully worthless or partially worthless, then you're good. But if it's non-business, only fully worthless bad debt can be deducted. Partially worthless bad debt cannot be deducted. So if it's partially worthless, you have to wait until it becomes fully worthless. Now, another thing to consider is that if it's a business bad debt, the character. So character is going to become more important in later topics, but just note the character for now, and I will tell you it does make a difference. For business, the character is going to be ordinary. It's going to be an ordinary deduction or loss, but for non-business, the character is going to be short-term capital loss. The character is short-term capital loss, also known as STCL, which I'll tell you that being a short-term capital loss versus ordinary is much better. When you have deductions, you want ordinary. For short-term capital loss, there's much limitations on that. So the other thing I want to mention, because some of you out there might be and have taken an accounting class or a business class, and you know that with respect to generally accepted accounting principles, when it comes to bad debt, the specific write-off method or specific charge-off method, as sometimes referred to, direct write-off method, specific charge-off method, that's not what's used for GAAP, but that's what we do for tax purposes. We use a specific charge-off or specific write-off method with respect to the debt because it's when it becomes bad. When the debt has gone bad, that's when it is. That really is the focus. versus the allowance method is what's used in GAAP, where you actually say, okay, well, in business, we understand that some of the accounts receivable are going to become worthless. And when that happens, before we do that, we're going to create a reserve, and we're actually going to take an expense before that happens. So again, the timing is different for various financial accounting. And then if you're practicing tax and you have a business entity, a corporation, you have to do the differences between the tax return and the financial statements. This is usually one of the biggest ones because there are differences with regard to timing, because you have that allowance, that reserve for your business's debt write-off that is done usually once a year, usually the end of the year as adjusting entry. But for tax purposes, it's done. You only write it off when it becomes bad debt, when it's gone bad. And that concludes this topic of bad debt deduction.